Well, welcome everybody, and a very special welcome and thank you to George for joining us. It's wonderful to have you with us, and I know that there's been a lot of excitement and anticipation for your opportunity to share with us today, so thank you. And of course, a huge thank you to Matt for always seamlessly bringing us all together and for hosting the webinar, so thank you to you too. And of course to Ross for doing all the hard work behind the scene of making sure that everyone's online, connected, and ready to engage. So thank you so much, Ross, too. So welcome, everybody. Lovely to have you all with us. And I hand over to Matt.
Thank you very much, Kate. For those of you who may have not had the opportunity to interact with Kate either, she's our head of human resources at Skybound Capital, and she's done an amazing job of helping put these webinars together, along with Ross, who is in picture there as well, Ross Muller. So thanks to them, and our chairman, of course, Cliff, and lovely to see the Skybound Capital, the logo prominent there. But as Kate said, a very special welcome to George Glynos of ETM Analytics. I'll get to introducing George in just a second, but also a massive welcome to our staff from all around the world at Skybound Capital. These webinars are proving very popular internally, and we're delighted to be able to share them more broadly. We have friends of the business, clients, independent financial advisors, literally from all over the world, and are very special clients as well. There is great anticipation around this discussion we're having today with George, because we had a session with George from ETM Analytics in November last year around South Africa's future, the future of the global economy, and my goodness, how things have changed since November, and how the outlook for both us as a country and indeed the global economy has changed. And that has made George and his team extremely busy. And so perhaps, George, just as by way of introduction, just a word on ETM Analytics, the work that you do, and for whom, and how we've ended up collaborating on a number of fronts.
Thank you, Matt. Great to be with you guys, and thanks for the opportunity. I'm finding I'm doing more and more of these webinars and Zoom presentations, and they're working quite well. Perhaps I won't need to commute anymore if this continues. But yeah, we've been around now for 16 years. We're a company that tries very hard to do things a little differently, in the sense that we are not backed by a big bank balance sheet, so we don't have the luxury of having a big brother looking after us. So whatever we do, we've got to do in such a way that it adds material value to people's lives, or people just won't want to listen to us, quite simply. So we do a lot of innovation, and we're a very innovative company, and we try and think about the world in different ways, but everything that we do is housed with very strong empirical evidence. So we focus on the future as much as we possibly can, but we don't enjoy doing econometric forecasts too much, purely because we don't find them useful. What we do find useful is understanding context properly. And if one understands context, it's a hell of a lot easier to make informed decisions. So it's about trying to unpack that context in the best way possible, and off of that, choosing how we look at scenarios and strategize around that. ETM has a very broad range of clients, ranging from corporates to banks, financial institutions, which include long-only as well as hedge funds. We have quite a substantial international readership now, which spans from America through London, across Europe, and into the Middle East and Africa. We cover a number of jurisdictions, which ranges from Latin America to the Middle East, to Europe, with a strong focus on Africa and emerging markets more generally. So the pool of information and data that we draw on for any of our views and presentations is quite substantial. It's quite broad. And it also allows us to interact with people internationally in a very holistic way. So we get a lot of input from our clients, that we interact with, but also from all the various markets that we look at. Of course, I'm not going to bore you with the full gambit of information that we have available to us, because we'll be here for days. But I have tried to pick out some interesting charts to show you guys today. And I know, Matt, you've got an agenda that you want to work through, so I'm going to hand over to you, and perhaps we step through it.
Thanks, George. Now, I think one of the things for me throughout the lifespan so far of this pandemic has been what to believe and what not to believe. There is all sorts of information flying around the world at breakneck speed. There are news organizations with agendas, and you can see that quite clearly in the way they direct their flow of information. So for me, it's really important to have an independent view like the one that you have, collating a whole lot of global information and presenting it as an independent view and an independent source. So while this might sound like a horribly generic question, let's talk about the effect of the global economy to date and looking into the future of this pandemic from your perspective.
Matt, we've also struggled with that. There's been a tremendous amount of misinformation out there, ranging from the medical to the economic to the political. There have been a ton of different agendas, some of it sounding quite conspiratorial, some of it genuine. I don't believe that we got the full picture that came out of China, and I'm going to show you why. Because at the end of the day, we do have to rely on data to drive our beliefs and our expectations on how things will unfold. And the early information that we got out of China simply didn't quite reflect the kind of collapse and the calamity that was in the pipeline. So I'm going to share with you a screen, and I'm going to step through it and give you some perspective on exactly what it is that I'm talking about. The first slide I'd like to show is what's happened to China's GDP. Now, in the way that this crisis was communicated to the world, China certainly did not paint this picture. So when we've just received the Q1 GDP figures out of China, it seems almost completely surreal to be talking about year-on-year growth rates collapsing by more than 10% in just one quarter. For China, that represents a collapse of some 16 to 17% in just that one quarter, which is absolutely enormous. Like you see, the data, China only started collecting from 1992, so I don't have more history to show you than that, but quite clearly, it's by far the weakest on record. And as you can see, when they talk about falling off a cliff, this would be a very good example of that falling off a cliff. So it was an absolute shock to the system. They literally shut China down. And as a result of that, we had a major collapse that followed. Even when we have a look at the economics, so some of the more esoteric data that we sometimes look at, we find that there is high distress being reflected. And I'm using China as the starting point because by definition, they led the world into this crisis. So if we're going to get any form of perspective on how big the hit is, China would be a good place to start, not just because it shows just how massive the impact was, but also because we can start to see the early signs of what a recovery, at least in China, would look like. So Citi's early warning risk index is still sky high at levels last seen during the global financial crisis. The economic surprise index recently hit a record low, suggesting that data will continue to surprise to the downside, but it has started to tick back up. If I step forward to the next chart, interestingly, you'll see the massive collapse that happened with the PMI, the Purchasing Managers Index, which gives you an idea of economic activity at a productive level. Interestingly, as they've started to open up, that's bounced back up. Now therein you see the V-shaped recovery that a lot of countries are talking about. There is, however, a colossal difference between China and the rest of the world. For starters, perhaps China understood the gravity of the situation and locked down very, very aggressively. They're a totalitarian country that's borderline dictatorial and can do so. Their culture allows for it, and they have the ability to enforce it. So the shutdown was very, very effective and successful in combating the spread of the virus. And it has therefore allowed them to open up proportionately, and we'll see over time, but open back up again sooner than many other countries might. And they will be able to reignite their production centers potentially in other countries. Now, if one has a look at the information that came out of the World Health Organization, they simply didn't paint this picture. This is not the picture that the World Health Organization painted. Hence, the very lax and sluggish response by Europe, for example, the UK and even America to the onset of COVID-19 and the pandemic that it was ultimately labeled as. If I just shift forward to what's going on in America, and I've had to focus on weekly data to give you a sense of just how big the impact is, because the monthly data hasn't come through yet. We don't have it all. So if I have a look at the New York Fed weekly economic index, which gives you a sense of economic activity, weekly economic activity, again, it has quite literally fallen off a cliff. And if we correlate that to GDP, we're talking about a GDP collapse of between 17.5% and 20%. That's coming, and that will hit probably towards the tail end of the first quarter and into the second quarter. So it is an enormous hit. We're talking about a quarter of the world's largest single economy just being removed out of any economic forecasting equations in literally a quarter, which in economic terms is an instant. It's a blink of an eye. So we've had a massive economic collapse and one that's still unfolding. So this data that I'm showing you right now on the screen probably gets worse before it gets better. So I'm not sure that we've seen the full impact of the shutdown and the lockdown. And perhaps when you see these charts and you understand these numbers, you'll also begin to understand and appreciate why the Trump administration is looking so actively at trying to end this lockdown, because it has been brutal. So if I scroll forward into some real economy data, also weekly, you'll see that rail traffic has quite literally collapsed off a cliff and very quickly heading down to levels that we saw during the global financial crisis. I suspect that we're going to surpass those troughs. We're going to dip below them through the course of the next couple of weeks. We just don't have the data that's caught up to reality yet, but it's in the post. The right-hand side is, of course, metal production, and it too is going to plummet to levels below those seen during the global financial crisis. So quite literally, this is a bigger hit than the globe took during 2009. So if we thought 2009 was a shock to the system, this is going to be that much bigger. And if I just go, one more set of slides forward to give you just how outsized the impact has been, well, we can look at the weekly jobless claims. So that's when people that lose their jobs go and claim for unemployment insurance. The left-hand chart is the amount of people that are applying for these jobless claims per week. The chart on the right is the accumulation of that. Now, the problem with the chart on the right is that it's smooth over 3 months. So it doesn't show the full extent of the continuing claims. In fact, if you have a look at the data for the past month, we know that 22 million people have filed for jobless claims in just 1 month. it implies that we're going to see an unemployment rate in the US surging to between 15 and 20%, which is absolutely colossal. I never in my lifetime thought that I would see anything as enormous as that. And so it obviously is a massive, massive hit, which of course has hit the smaller companies proportionately more. So if you have a look at the chart that's now coming up, you'll see the way that the small caps on the New York Stock Exchange have been hit proportionately far harder than the large cap stocks. And that's for good reason. I mean, the big companies have got the ability to raise capital in the bond market, for example, and they've been backstopped by the Federal Reserve, and so they've been able to do that. They will be able to bridge the gap from before to after this crisis, and they will live to fight another day. Some of the smaller companies, not so easily. They don't have that same access to very liquid bond markets and capital markets. So they've been sold off very aggressively, which stands to reason, and it also gives you some perspective as to why the fiscal authorities in America are doing everything that they can to potentially even grow the fiscal stimulus that they've put forward. So the 2.3 trillion might very well creep up to something approaching 3 trillion through the course of the next month or so, as they realize that the amount that they earmarked is simply not big enough to cope with the magnitude of this crisis. So can you imagine that you've got a Federal Reserve that is conducting quantitative easing? It's already built its balance sheet by approximately $1 trillion in just the past month. That you've got a federal government that's going to be throwing a further $2 to $3 trillion at the problem, and that it still might not be enough. So the economic hit is enormous. And so I thought I'd bring up some of the IMF's growth forecasts for 2020, so that you can see that it is completely broad spread. It's very widespread. And these are annual growth rates. So these don't reflect the magnitude of the impact that we're going to suffer in the first and the second quarters of this year. They show what the impact is on growth, including what they're anticipating to be recovery quarters in the third and the fourth quarters of 2020. And yet you've still got countries like Italy, if you have a look at the top part of that table, that are expected to contract by around 9%. I think they could quite easily, like America, looking to shrink by 6%, and they were one of the most resilient going into this. That's the reality that we're living in at the moment.
So George, if we pick up on some of those things, I think a common theme that we've all been exposed to in the last few weeks is the effect on smaller businesses, SMEs, massive fallout there. But if we add that as well to the decline in the economic activity in, as you say, in China and the US, the ripple effect for the world is a very obvious one. But I'd like, if we can, to move to the specifics of the effect on South Africa, which had more than enough problems of its own, as we discussed at our ICM in November in our offices before any of this unfolded. And perhaps your views on that, the specific effects on South Africa, where we are today.
So to answer that question, you first got to understand the background context. And the background context to that was that South Africa wasn't in a good shape, wasn't in a good position before we went into this crisis. So these were the factors that I had the biggest problems with. We had populist politics. We constantly were looking to try and focus on garnering political support, as opposed to, we followed some very socialist principles, which would be fine if you had a tax base that could support it. But South Africa's tax base is an extremely small one for the size of the population, and it has been shrinking. Not to mention that there's been an immigration, not just of people and of human resources and capital, but of actual capital as well. We've got this environment of rank disrespect for taxpayers. There just isn't enough respect shown for how difficult it is to make money in an environment like this. and what a sacrifice it is to be paying some of the taxes that South Africans are paying, only for it to be utilized in very inefficient ways, to be maladministered and whatnot. But it's to say that South Africa had many, many problems long before this crisis unfolded. And it was all about the fight for political legitimacy. So whether we talk about SOE bailouts and protecting labor, heading down the roads of NHIs and land reforms and flying kites about Saab nationalization and even talking about some fanciful things like banks are not housed in any economic logic of any sense. We can't afford most of this. Finally, we're going to allow SAA to fail. It only took a global crisis of biblical proportions for them to be forced into making those decisions. But it does come as a good example of what happens when fiscal space simply runs out. And in this instance, fiscal space has run out. So we cannot afford to continue bailing out poorly run state-owned enterprises anymore. Labor protection has to be looked at. That the government is struggling and having to enter negotiations with unions. And the fact that the Ramaphosa administration perhaps simply doesn't carry the amount of political weight and legitimacy that it requires to implement policies in the way that it needs. For huge scrutiny now, I don't know which way it swings. On the one hand, they might use this crisis as proof that the public sector healthcare system wasn't good enough and needs to be reformed. On the other hand, they might look at it and say, well, it's just a project that we cannot afford now. At this point, I haven't seen enough evidence of which way they're going to tilt to be able to give you a sense on how that unfolds, but they are going to struggle to finance it, just as they will land reform. Nationalization is going to be an interesting one because I was reading comments from Michael Sachs this morning in the Business Day, where he was talking about the state needing to pool all resources, both fiscal and monetary, to combat this thing. And he even referred to reserves. Now, the only reserves that my mind turned to was the Reserve Bank's reserves, and there's a good 650 odd billion rands worth, now with the rand weakening even more, maybe 700 billion rands worth of reserves that they can potentially tap into. And it speaks to the concept of sovereign wealth funds and whatnot. But it's a dangerous, dangerous game to play. So we're fighting for this political legitimacy. Just very quickly going to run through two charts just to show you where we were prior to this crisis. Our leading indicator was already in negative territory. It was below that zero break-even mark. And so just from that perspective, you could see that the economy was more prone to contraction than not. We know that industrial earnings were the colossal crisis hit. So now you may ask, well, what does that mean for South Africa? And so we've tried to give you a sense of just how big the impact is on South African growth, depending on the length of the shutdown. This is an important chart in that we tried to put together our best estimate on what the ultimate impact of this crisis is going to be. And specifically, it's the lockdown. Let's be quite clear that the virus itself isn't the thing that collapses an economy. It's how you respond to it. And the response being the lockdown is what does obviously all the damage. Now, if you have a look at the second block, you will see that we've put there months of policy is the yellow band running sideways. This real GDP, well, that's just a starting point of 100. Call it 100%. So in the yellow, you'll see 1, 2, and 3. That's months of lockdown or shutdown. So if we only, so the way to read that is in the very first column under the number 1, you'll see under month 1, you've got 70%. That figure represents a collapse of 30% in the first month of lockdown. If it progresses beyond the first month, so if we go to the second column under the number 2, and you scroll down in that yellow patch, you go from 70 to 60%. The economy has just shrunk by 40% over the 2 months. And if you go across to the third month, you shrink all the way down to around 40% of the size of when you started. So the impact is colossal. It is truly an enormous impact. Now that's on a full shutdown. The semi-lockdown is the next portion of that table, and you'll see the numbers are slightly less dramatic, but still big nonetheless. So what do I take out of that? Well, I think that on the basis of the impact and the way that we see it, we think that it's quite realistic to be looking at a 2020 decline in the order of between 5 to 10%, but probably closer to the 10%. The second quarter in South Africa is going to take an enormous hit. I would expect GDP to shrink by around about 15 to 20% in just that one quarter. And assuming that South Africa then rolls back on the lockdown and the shutdown, then you'll see recoveries unfolding in the third and the fourth quarter. But recall that the first quarter was already a difficult one. South Africa was in recession prior to this crisis already hitting. So we were fragile and weak to start with, and then the crisis hit. So it's going to be a very, very tough year for South Africa. And if you're talking about a contraction of close to 10% in just 1 year, that is very, very difficult to recover. And it will probably take us anywhere between 2 to 3 years to just get back to the levels of GDP growth that we or levels of GDP activity that we were at prior to the onset of the crisis. So it is indeed a huge hit, and it's the reason why we feel that it would be irresponsible for the government to continue with this lockdown. It's becoming very, very clear that on a number of fronts and across a number of countries, that it's simply unsustainable. And the amount of damage being done to the capital structure of the economy and create more social unrest than the virus itself. In other words, you've got this horrible choice of being able of needing to choose between lives and an economic structure. You're going to be damned if you do, damned if you don't. So from an economic perspective, we hope that they don't extend that lockdown any further, because the amount of damage being done to South Africa has been enormous. And so it's going to be progressively more difficult to recover from it the longer we continue.
Yes, indeed. And also a discussion around some of the interventions that have occurred so far, George, and maybe others that will follow. So, we've seen 2 rate cuts of 100 basis points each during this period. There's been talk around approaches to the International Monetary Fund, the World Bank. What is your view on those? And I think maybe we have to lump into all of this the effect of the Moody's downgrade. I remember you saying in November your only surprise was that it hadn't happened already. It was largely and quite widely expected to happen. But when you put all of those factors together, does it potentially create a scenario in which the decision-making at government level on the economy can be less politically driven and more driven by absolute fundamental requirements that need to take place?
The chart that you see on the screen there reflects what we think is going to happen to tax receipts, and we think that they are going to collapse. Alongside the leading indicator, the data just doesn't reflect it yet, but in both those lines are going to head substantially lower. The Reserve Bank quite rightly went and slashed interest rates, which you can see how different their behavior has been. So when we have a look at our risk, inflation risk indicator, and we look at that versus repo, you can see how the Reserve Bank has abandoned their traditional focus on inflation in the way that they typically do, and have very boldly and preemptively slashed interest rates. I don't think that the 200 basis points is the end of the story. I think there may even be more rate cuts to come. in speaking to the Reserve, do quite a lot more. And in fact, they've stretched themselves. They are doing quite a lot more. It's not visible to the man on the street, but there was a tremendous amount of distress that unfolded in the bond market a couple of weeks ago, to the point where the banks themselves were released of their obligation to stress that National Treasury just about put a halt to the way that the bond market was functioning and called on the Reserve Bank to assist. The Reserve Bank will never tell you that they are outright helping National Treasury. They'll tell you that they are strictly focused on the efficient operation of the bond market. But that's kind of couching it, if you like, in a slightly different way, because without that efficient functioning of the bond market, National Treasury or government simply can't raise funding in that market. So, I mean, they might couch it as that it's not there to assist government, that it's there to ensure efficient market operations, but it is there to effectively support the government and National Treasury's capital funding requirements. So without the Reserve Bank's interaction here, at a level far deeper than just the rate cuts that we're seeing, I think South Africa would have faced imminent collapse. And I think we were so utterly close to being in default territory. No one realized it, but it happened about 2 weeks ago. They liquefied the money market quite aggressively to assist the banks to be able to fund themselves for ongoing operations in the money market. They equally stepped into the bond market and indicated that they would be prepared to purchase bonds and build the size of their balance sheets in a similar way to what the Fed and the ECB and the Bank of England does with quantitative easing in a bid to normalize market conditions. Now, just the threat of that seemed to be enough, because in reality, they actually haven't bought that much to show the market that they're prepared to backstop an ill-functioning market such that they would be able to normalize it. And in so doing, they've effectively helped National Treasury to be able to raise capital in the open market. So the Reserve Bank has been extremely active, and thank goodness, because without them, I think South Africa would have been going cap in hand to the IMF. Now, therein lies a sort of an interesting one, because you raise a very important question there, in the sense that, can we find a way to depoliticize the decision-making process of government? And one way of doing that would be to go down the road of an IMF bailout or a World Bank bailout or any other sort of bailout of sorts. And why? Well, quite simply because they start to dictate how economic policy needs to run. And all of a sudden, now that you don't have a choice in the matter, you take decisions that are politically unpopular. But the political elite almost have an out, if you like, to be able to say, well, this crisis hit us out of the blue. We had no control over this crisis. It's plunged us into this very difficult environment. We're forced to go down the road of asking the IMF and other bodies for assistance. But the only way that they're going to give us this assistance is if we impose austerity type measures that would be deeply politically unpopular. So they absolve themselves of some of the blame of having gotten South Africa to this point. But it's the reason why I showed you those charts around South Africa and where we were even prior to this crisis, and that things weren't good prior to this crisis. Because whilst they might try and absolve themselves from that reality, the truth of the matter is that they have played a very active role in taking South Africa to the brink through the course of the past 10 years. Now, it does imply that that we may need assistance. And I think if this crisis unfolds any further globally, and that V-shaped recovery that's unfolding in China doesn't necessarily replicate in other jurisdictions such as America and the UK and Europe and Africa, then all of a sudden we're staring at a very different scenario. Because as it was, South Africa was running a budget deficit of around 8% to GDP. That was what was in the budget. You go and shrink South African GDP by anything up to 10%, you're talking about a budget deficit that explodes to around 15%, if not worse, in just 1 year. It means that our debt pile rises from 60% to 75% in just 1 year. And the year that follows that is equally going to be just as damaging, because you can't unravel these fiscal structures that are already in place very quickly. So it means that we rapidly rise towards levels of 80, 85, possibly even 90% debt to GDP in the space of 3, maybe 4 years. And that's quite simply unsustainable. I don't believe that the markets would tolerate that. The ratings agencies clearly have downgraded South Africa. Eventually, Moody's did respond. Better late than never, but I mean, they're still behind the curve. Some of the other ratings agencies have already cut us to a second notch below investment grade, and I think Moody's has got some catching up to do. So we're in a tough fiscal space right now. I think South Africa has itself to blame in many respects. The policymakers haven't been quick to respond to a fiscal threat that was building over a long period of time, and now we find ourselves in uncomfortable territory. Well, interestingly, so we've had a look at a number of countries that were investment grade and then dropped out of investment grade, and had a look-see what the impact was on exchange rates and bonds. Now, interesting to find that post the downgrades, quite often these markets tend to be a lot more stable than they were even prior to the downgrade. So on the left-hand chart, we see that there has been some depreciation in currencies, but the depreciation came in currencies to which the downgrade came as a shock. The currencies that experienced the downgrade that was telegraphed to them long before the downgrade, like it was for South Africa, in fact experienced a very stable environment in the many months that followed that downgrade. Now, South Africa is the yellow line. If I look at the left-hand chart, South Africa is the yellow line. We've just been downgraded, so we're at that critical midpoint. It suggests that we are likely to have a lot more stable currency than people fear. The right-hand chart talks about the impact on the bond markets. And interestingly, what we found is that in many cases, the bond market tends to outperform in the years following the downgrade. And the very simple answer as to why that is because so much bad news was priced in prior to the downgrade. So that once the downgrade is realized, in fact, there's a big chunk of the investment community out there that now says, okay, well, that's behind us. Now we've reset to these yields. Is there value? Yes, there is in relative terms. We can extract at the long end of the South African yield curve anything up to 10% or more. That's really attractive with an inflation rate sub 4%. And therefore, we think this is a great opportunity, and they start to buy back in, which again, I guess, frames the picture a little bit for a discussion that I know you had on your agenda, which was about potential performance of the rand. But I'll let you lead me into that unless there are other questions that you may have.
No, I think it's the perfect time to discuss that. Obviously, when the interest rate cuts were announced, we saw some pretty quick response to the value of the rand, and I guess what a lot of people are asking, and certainly over the last few days, George, we've got questions from clients, from advisors, from within our own team, is that what is the range, and where do you think that the rand bottoms out is the key question.
Thanks for that, Matt. So we have a valuation framework that we've used for a very long time. It's reflected in that chart that you currently see, and we've used it to great effect historically to isolate and pinpoint periods where there was value to be found in rand. What should be obvious when you look at that chart is that quite clearly the rand has been pummeled in the past few weeks. That blue line dipping to under 30% undervaluation is a very, very sharp move. It's a move much sharper than we saw even during the 2001 collapse of the rand, but it was sharper than we saw during Nenegate, and sharper than we saw during even the financial crisis of '09. So it's been a very precipitous drop. But it's taken us to a point where suddenly investors are starting to look at the discount that this weakness in the rand offers and are starting to think about South Africa a little differently. It's not to say that they don't see the risks and the problems associated with South Africa. Everybody knows that there are some major fiscal problems that need to be overcome. Everyone also understands that there are some structural constraints to the South African economy that aren't going to make implementing reforms particularly easy. However, at a financial market level, there are some tremendous discounts to be had. And the first is obviously visible in the currency. So we're sitting at about 33% undervalued as we speak. That is a tremendous, to fair value. That is a tremendous amount of discount that we see, and it corresponds very closely to the kind of drops that we saw in '09 through the global financial crisis and Nenegate at the end of 2015, beginning of 2016. In both those cases, these sorts of levels were not sustained. The one exception is the collapse that we saw in '01, in December 2001. Where we went as far as just over 40% undervalued. It's not to say that the rand can't go to 40% undervalued, but I would say that I would be very reluctant to be buying dollars from these sorts of levels. Simply put, the rand is trading at such a discount. I think that the risk has asymmetrically shifted away from substantial further rand weakness, and we need to get our heads around the possibility that we are very close to the bottom, if not bouncing into the bottom of the rand's depreciation. And perhaps I'm just going to show you a couple of charts that might give you further perspective as to why. So what we do know is that South Africa's terms of trade through this crisis have improved, interestingly. And the main reason why is if you have a look at the chart on the right, you'll see that the rand has performed quite poorly. It's second from bottom. It has lost 25% just through the course of this year alone. But have a look at what's happened to oil, which is the one at the very bottom. It has dropped almost 60% in the same time frame. Now, oil is South Africa's single biggest import. So if oil prices fall off aggressively, it means that for our trade and our current accounts, that is really good news. And you can see that in the left-hand chart. So our terms of trade index have popped back into positive territory, the first time that we've seen that since the back end of 2017. And if we get a slight recovery in metals prices whilst oil remains subdued, well, that number could rise even further. So that chart could look even better. So let's just go back 2 steps. So we've got a currency that is extremely undervalued and pushing the limits of what is sustainable. And we've got terms of trade that have turned positive. If I have a look at our sentiment indicator, yes, there's been a collapse. Yes, it has dropped into negative territory, which typically points to some rand distress and weakness. But if you have a look at that chart and focus specifically on the black line, which is the year-on-year growth in dollar rand, it has deviated from the path of the rand sentiment indicator quite aggressively in a way that we believe is quite simply unsustainable, and that the sell-off wasn't necessarily fully justified. So whilst that rand sentiment indicator has weakened, it hasn't collapsed. And I think that's an important point to make. So rand sentiment hasn't collapsed, the rand is deeply undervalued, and our terms of trade have improved. Roll forward to the possibility that the dollar itself might come in for a correction because it is very overvalued, and there specifically you need to focus on the blue line in that chart. It is overvalued, and all you require is the dollar to come under a little bit of pressure, partly because of the approach that they've pushed forward, which is going to leave them with a tremendous amount of debt and very aggressive loosening in monetary policy. Both those factors could count strongly against the dollar, and we believe that they will. So if your dollar corrects weaker because it is extremely overbought at a time when the rand is extremely oversold, well, that in itself is a recipe for a correction of sorts. And if you look back through the history of this chart, you'll see that that red and blue line often oscillate and cross over each other at periods of time. At the very least, we would expect the red line and the blue line to move back towards each other at some point in the future, which again is talking about the possibility that rand can stage a recovery. Also important to note that when we look at our carrier attractiveness index, which takes a number of factors into account, it takes valuation, it takes South Africa's level of interest rates, it takes South Africa's inflation and risk-adjusted returns into consideration. It takes all of these factors into consideration. It hasn't collapsed as yet. Rand carrier attractiveness has not collapsed off a cliff, and so it has remained reasonably resilient, and in fact slightly better than the emerging market average. The y-axis on the left-hand side simply is a score out of 10. That's all it is. So at 5 out of 10, that's not a calamity. You can work with 5 out of 10. It's not brilliant, but it's not a disaster. And just the mere fact that we're slightly above the EM average means that we shouldn't be ostracized just because we've got our domestic problems. One could argue very strongly that our domestic problems have been adjusted for by virtue of the weakness of the currency, the discount that's offered, as well as the weakness of equities and bonds at the same time. Perhaps the final chart to just highlight is also the one that we look at rand resilience. Now, this takes a number of factors into account. It's a huge model. It looks at monetary rectitude, in other words, the behavior of the Reserve Bank. It looks at fiscal risk, which is the behavior of government and South Africa's fundamentals. Puts it all together and comes up with a score out of 10, which is the y-axis on the left-hand side. Now, the blue line, which is our overall resilience score, has deteriorated. There's no question about it. The biggest detractor from it is, of course, fiscal risk, where South Africa is now scoring less than 2 out of 10. It's a colossal fail. South Africa ranks last out of 22 countries on this measure. So we're doing a particularly poor job with regards to the fiscus. But have a look at how well the Reserve Bank still does. So they are still scoring north of 7 out of 10, despite the fact that they've cut interest rates. That green line may come off, probably will come off, but it's also a relative measure. It takes South Africa's monetary policy relative to monetary policies that are being conducted by other countries around the world. And so that's why there is no grand collapse there, because everybody's cut rates aggressively at the same time. So South Africa can thank the Reserve Bank that we still have a currency that hasn't completely collapsed. But there's no question in my mind. I know, Matt, one of the questions that you had was, what does South Africa need to do going forward? Well, it needs to fix its fiscal mess. Right now, we're at a record low on South Africa's fiscal risk score that we keep, and it's detracting a lot, not just from the rand, but from general sentiment, strategic planning, and the like in South Africa. So it needs to be dealt with, and dealt with aggressively. This particular chart is the chart that worries me about South Africa's longer-term future. So whilst I might talk about rand staging a recovery in a tactical sense, in other words, over the next few months, perhaps second half of this year, I think rand can stage a material recovery from these levels. But if one has a look a little bit beyond the here and now and starts focusing on next year and the year after that, it's that red and the black line that bother me a lot. We're not scoring particularly well. It's mostly driven because that red line, which is our fiscal risk, is collapsing. And it's the reason why, Matt, you even talking to me about the possibility of an IMF or a World Bank bailout. We wouldn't be talking about that if that fiscal risk was more like it was in periods of 06, 07, which you can't see at the moment, where that red line was sitting at 6 and 7 out of 10. So in the days of Trevor Manuel, when we were running budget surpluses, we were scoring really, really well on this red line. But it's been a steady slide, and you can see the damage that's been done over the 10 years. And it's culminated in this. It's left us very vulnerable, and this latest shock has now just tipped it over the edge. So South Africa is in a very precarious position, and that's the risk longer term.
I'm going to come back to one final question on this, George, if I can just pause for a moment, because you gave some very specific view on the dollar. If we could just ask you, I know you probably won't have a chart on this specifically, but just your view on other global currencies right now, or certainly, those that are of greater interest to us. If you look particularly at sterling, euro, possibly Aussie dollar, just your view on global currencies and how those markets might play out.
Yeah, so I mean, the dollar is overbought against just about every currency that I've looked at. It's been the case now for a while. And what we've seen through this crisis is this rotation towards the dollar and towards safety. That is something that holds true across the spectrum. So, I mean, you mentioned Aussie dollar. Aussie dollar is also offering some tremendous value. It has been sold off hard. The euro is offering value. It has been sold off hard. The pound is offering value. It has been sold off hard. It had the complication of Brexit over and above that. So, this is more of a general dollar view than it is necessarily about specific currencies. But I suspect that the dollar itself needs to come in for correction. It is overbought. There's no question about it. It's been overbought for a very long time because the Fed was running quite a tight monetary policy relative to most other countries around the world. That's changed. And so whilst for now, the dollar still benefits from a safe haven play, I suspect that it doesn't necessarily remain that way forever. So once we get through this crisis and we start looking at recoveries and more stable environments going forward, I think that the Fed's behavior and the aggressiveness that they've applied to their monetary policy probably starts to detract a little bit from that dollar, and you see currencies more generally starting to recover against it. So, we can talk specifics about each currency, but I think for the most part, I would say that this is more a general dollar view, Matt, that it needs to correct because it has been overbought for quite a long period of time.
Okay. George, time has absolutely flown by. I'd like to sort of finish off with this question. Your slide is still up there, long-term outlook vulnerable for South Africa. And what's been clear to us in this hour is your independence and your clarity of thought. So I pose a scenario to you now. ETM Analytics, George and his team are appointed special advisor to Cyril Ramaphosa and the government. What would you be doing in the next, let's say, 12 to 24 months? What would be your utopia, if I can put it that way?
It's a good question. I get asked that question quite a bit, and there's actually quite a lot that can be done. South Africa is very salvageable. I think that we need to just rethink the approach that we've been taking in terms of economic policy. So where to start? I think we focus too much on government being drawn in to be the savior of the economy. When in actual fact, they're just an actor like any other, and in fact, an inefficient one at that. So the first place to start would be to shrink the burden that the state places on the tax base. And you do that by shrinking its role, quite literally. Now, I'm not suggesting that you suddenly cut off government grants and the like, but there is a lot of evidence, and you just have to look through the Auditor General's report to understand just how inefficiently government is being run. It's being maladministered and badly run. So the deployment of technology, for example, would bring tremendous amount of efficiencies back into play. It would ultimately translate into a lot more accountability. Equally, we would have an environment where you would have a government that because you're using that technology, you would shrink significantly the burden of a public sector wage bill, which is the next thing. You have to shrink the public sector wage bill, and you have to shrink it significantly. So you start off with the technology and making things more efficient. You shrink the size of the workforce dramatically. You have to cut back on the size of ministries and the amount of ministries because they are just not needed. And there are many countries around the world where things like ministries of sport just do not exist. They're not necessarily needed. There are bodies that can take care of that. You don't need such ministries, and there's a lot of superfluous political activity that effectively is the gravy train. But far and beyond that, what you really need to do is to limit the extent that political interference can have in fiscal decision making. And so there are countries around the world, probably your best example of this would be a country like Germany, that have implemented very rigid fiscal rules that simply do not allow the politicians to spend more than they have to. And so it focuses the mind not only on extracting the most that you can out of the available resources that you do, but it prevents them from running budget deficits that are substantially larger than the GDP growth rate, resulting in a debt pile gradually accumulating over a long period of time. So you want to implement a fiscal rule, and you want to stop the fiscal authorities from being able to do what they've been doing for the past 10 years, which is taking South Africa's debt to GDP from a very comfortable 25% when we were several notches above investment grade, all the way to a point where we now a couple of notches below investment grade, and we're sitting with a debt pile that's we're rapidly going to be staring at 80 and 90%. Clearly unsustainable for a country that runs interest rates of 10% plus in the bond market. So that's absolutely critical. Now, there's a lot of fat that can be trimmed out of government expenditure and budgets. And if I just look at the budget for the past year, if we didn't have the unfunded liabilities that were sitting in state-owned enterprises, that would have made a huge difference. So you want to unbundle these things. If you have an ideological problem with privatizing completely, then at least you can go down the route of partial privatizations. But partial privatizations would not only introduce the private sector into that realm, and we know that the private sector runs things a lot more efficiently, not without corruption, and I'm not saying that's the be-all and end-all, but we do know, and we've got examples, such as Telkom, where this has been done, and it's been done successfully. So to be able to do that and then introduce and crowd in the private sector rather than constantly pushing it out would be a tremendous positive, which I would wholly support. We need to liberalize our markets. The most notable ones are our network industries. So electricity is just one, but we need to let the private sector compete with Eskom. Our railway industries is another. We need to allow private companies to be able to compete with Transnet. We need to look at the ports and potentially get consulting companies that focus predominantly on running ports to do so efficiently and reduce the backlog that sits in the ports and promote trade. You need to focus on water, reticulation, and the infrastructure that goes in, and open that up to the private sector. There's just so much that can be done on the infrastructural side of this economy, which would be a massive boost, but not just to the country's balance sheet, because you would actively get a lot of money in that you could utilize to pay off debt, but you would actively be improving and building on the dynamism of that economy, which would directly employ people. Which brings me to the point of labor, the labor relations and the unions that we have, and the very militant relationship that we have between the unions and the private sector. That has to change, and it has to change to become something more normalized. We're on the far end of the extreme, and if you have a look at and that's not my opinion. It's if you have a look at the World Economic Forum's data on ease of doing business, and they're subdivided into various categories, and labor is one of them. South Africa ranks stone last out of 140 something countries. South Africa is right down at the very bottom in terms of labor relations. Now that's just not good enough. So it's just not good enough because we've got such a big amount such a huge population of unemployed people that cannot be allowed to continue. It's simply unsustainable. But part of the problem is, of course, that many of those individuals are not employable. So, of course, with all of this, you've got to have a holistic approach to working on things like education. And education, not in the normal sense, because otherwise we would be leaving out generations that have had access to very poor educational standards. But thinking about things differently, and there are countries around the world where they have focused on stuff like this. Singapore, now, not to bring up a whole bunch of ill feeling, but when Helen Ziller mentioned Singapore as an example of how to conduct an educational policy, she brought it up because she saw firsthand a country that had a lower GDP per capita than South Africa and chose to focus their energies in very specific ways and generated a tremendous payback in the way of economic growth and dynamism and employment, which has flowed and just been built on and gone from strength to strength over multiple generations. It's a shining example of how things should be done on that front, and South Africa didn't go that route. Much to all of our frustrations, we're now sitting with a desperate overhang of people that cannot be employed in a modern day economy. And so there's a lot that needs to be done, Matt. I mean, I could keep you here quite literally for days talking about the stuff because I'm quite passionate about it. But South Africa is salvageable, absolutely salvageable. It's a great country, and it's got lots of natural resources, and it's got huge amounts of a workforce that can be tapped into, but the right decisions need to be taken, and greater emphasis needs to be placed on crowding in the private sector if it's going to make a big difference. And so I'm looking forward to the course of the next 6 to 12 months, because I'm hoping that this crisis gets utilized as an opportunity rather than as another reason for despair, and prompts our policymakers to rethink the way that they've been conducting business. Because quite honestly, the way that they've been conducting it is completely unsustainable. And I think they know that. Tito Mboweni is a smart individual. He's kind of alluded to this. If you've been paying attention to his comments over the past few months, he's been alluding to this for a while. He just hasn't been allowed to implement what he needed to implement. So let's see if this crisis is the catalyst for doing things differently. And I hope and pray that he heeds the calls from the private sector, many of which have been given, mine included. And we hope that he responds in that way.
Well, George, I must say, you use the word passion. Your passion is evident and infectious. So too your pragmatism. And if I can use a horribly simplistic way to sum all of that up, it would be, where there is a will, there is certainly a way. And I can only thank you most sincerely on behalf of all of us for these incredible insights. You say you could keep us engaged for days. I believe you. And I think we would quite happily stay engaged for days, because it's one thing to look at the shocks and the downside of things, but quite another to explore the opportunity that exists as a result of those. So I need to wrap it up by thanking you and handing over to Cliff for some final words.
Thank you, Matt.
Thank you, George. It's been fascinating, and I'd welcome another session to have your views on global economies. As you know, our head office is based in London, and we're more of a global business than we are a South African business. But we have an interest in South Africa. But it's been a pleasure having you and sharing your insights. It's been very, dare I say, insightful.
Fantastic. Thank you, Cliff. And I would welcome the opportunity to do a very globally focused one. As I said, we've got tons and tons of charts that we can show you and play with, which are fascinating in themselves. But thank you for the opportunity. Much appreciated.
Thank you. And to ETM. Thank you. Kate?
Great, awesome. Well, thank you so much. Thank you, Cliff, for wrapping it up. And thanks, Matt, for hosting another incredible session. And again, just want to reiterate the thankfulness to you, George, for spending your time with us this morning. And I think we will definitely look forward to the next exciting episode as we look more globally. So thank you so much. And yeah, have a lovely day, everybody. Go well.